The Peter Schiff Show.
Happy New Year, everybody. This is Peter Schiff, and this is my first podcast for 2015. And, it doesn't really feel like 2015. I can't hydrate a pizza. I definitely don't have a hoverboard. I don't have self-lacing sneakers, and my jacket doesn't size adjust by itself. I definitely don't have one of those gadgets that walks your dog for you, that just hovers around and self-walking dogs. There's no Mr. Fusion in my kitchen, that's for sure. I can't hang upside down, suspended for my back. I remember that scene. Unfortunately, we still have lawyers, and we still need roads, and those roads are in need of repair. Who knows when we might have flying cars? Of course, I'm referencing Back to the Future Part 2, and it's hard for me to believe that I'm now living in the year that was depicted in that Robert Zemeckis film back in the 80s. I still remember watching the original Back to the Future 1 when it came out. Time sure does fly. Although I guess we have a few things that maybe they didn't predict. We got the smartphones and text messaging and a few things that they didn't get. Well, I think in that movie there were a number of things that they might have gotten right. But it just shows you, when you think about what the future is going to be like, many of us, it's really hard to imagine what may or may not be developed. And I think for a lot of us, just seeing a year or two into the future, I think is often very, very difficult, let alone trying to look 30 years into the future and postulate on what they're going to happen. I remember my dad telling me when he went to the 1939 World's Fair, one of the things that everybody assumed that they had an exhibit of the future. And I forget what year it was. It was probably like the 1980s. I don't know what year they were predicting. They were looking at back then. But my dad tells me he remembers that they had big dioramas, of neighborhoods, and everybody had helicopters in their driveways. So people have always been thinking about flying cars, but I guess the helicopter was a relatively new invention, and people figured that, well, everybody's just going to fly around in helicopters. No one's going to actually have an automobile. We're all going to have a helicopter. I can imagine the accidents that would be taking place if we all tried to fly around in helicopters. They are relatively difficult and very expensive still to be able to afford a helicopter. But I want to talk about what's been going on in the markets the last few days. Normally the end of the year, the last day of the year, the first day of a new year, they're typically positive days in the market, especially when the market has been trending higher. Not so this year. We had a very big sell-off for the final day of the year. I think the Dow was down about 160 points on Wednesday. And we got a snapback rally early in the morning on Friday. But by the end of the day, the market had sold off. The Dow was still positive by about 9 points after having been down maybe 70, 80 points at one point during the day. But the NASDAQ still finished down. The S&P finished lower. So S&P lower the last trading day of the year and the first trading day of the year. We got a lot of economic news that came out on the Wednesday and the Friday. Almost all of it bad, which again is par for the course. We get bad economic news, and then nobody seems to care. We got the initial jobless claims that came out on Wednesday, a day early because of the market closure for the New Year's Day holiday on Thursday. Initial jobless claims rose a greater than expected 17,000. 298,000 is where they stand, just below 300,000. But what's more significant to me is if you look at a trend, we have had falling unemployment claims now going back for several years. That trend to me seems to be over if you look at the chart. We're back at levels that we were at 6-7 months ago on claims. So we are no longer falling. And to me, it looks like the trend is reversing. And I think that you're going to see a substantial pickup in unemployment claims in 2015. We might be back above 400,000. Not only get back above 300,000, but by the end of the year, we might be above 400,000 weekly unemployment claims as businesses continue to shed workers when the recovery, the promised recovery, fails to materialize. Also, on a Wednesday, we got Chicago PMI, right? It unexpectedly dropped to 58.3. Again, unexpectedly is the key word because nobody expects the bad news. It just happens anyway, right? They were expecting 60.8 for the PMI, and instead it came in at 58.3. That is the lowest level in 5 months, and it's the second month in a row where we have come in below expectations. So those were two bad releases that came out on Wednesday. But on Friday, we had the trifecta. We had 3 reports. 3 of them were bad, all 3. First, we got December PMI, the manufacturing index, dropping for the 4th consecutive month to 53.9. That was the lowest level since January 2014. Production was weak. Employment was weak. So everything about the report was negative. The expectation, though, it was still for a decline, but the decline ended up being a little bigger than what had been expected. Although that might have been the best of the reports. Construction spending for November, unexpectedly, again, there's that word, fell 0.3%. It's the first monthly drop since June. Analysts had been anticipating a 0.5% gain, but instead they got a 0.3% decrease. But probably the weakest number of them all was the December ISM. That index fell to 55.5. It was supposed to fall a little. Instead, it fell a lot. This is the lowest level since June, and it's the biggest miss of expectations since January. Again, that was the polar vortex. So we get 3 out of 3 negative economic reports. You know, the stock market was positive this morning, up over 100 points. It's possible that all of that negative economic data took its toll on the stock market and sent it lower. But not so for the dollar. The U.S. dollar shrugging off all of the negative news and having one of its best rallies in some time, across the board strength against the euro. The Canadian got crushed. I don't remember seeing the Canadian dollar down this much. It was down at least 1.5% on the day. Big drop in the Canadian dollar, but the dollar rose against the yen. It rose against the Aussie, the Kiwi, the Scandinavian currencies. The dollar was strong across the board, despite all of this weakening economic data. The Canadian dollar, of course, also being weighed down by the drop in crude oil, which extended its decline. We closed around 52.50, new lows on the move for the price of crude. You know, everybody is worried about the impact that falling energy prices will have on the Canadian economy, but nobody is worried about the impact it's going to have on the American economy. We've got a big oil industry too. I mean, we're not a net exporter like Canada, but we have many states that are net exporters. We have a lot of big states that their economies are very, very dependent on energy. But we have a large energy industry that has been built up predominantly over the last few years, responsible for all the decent job creation. And all of that is now in jeopardy. Yet nobody seems to worry about that with respect to the U.S. dollar, but they worry about the Canadian dollar. But the real catalyst for the dollar rally were comments made at a press conference with Draghi, the head of the ECB. And this is all he said. Right? I'm just going to quote word for word what Draghi said. Quote, "The risk that we don't fulfill our mandate of price stability is higher than it was 6 months ago." Now, so what? Now, what does he mean by that, by price stability? He means inflation of just under 2%. Again, that is their definition. Their new definition of price stability is prices that rise by just under 2%, right? Just under. So I guess it's 1.9% is if prices go up by 1.9%, you have price stability. If they go up by 2%, you don't. If they go up by 1.5%, you don't. There's a magic number there that they've divined from the heavens as to what is price stability. Although, you know, you would think that price stability meant that prices were actually stable as opposed to rising by 1.9% a year. But no, price stability means prices going up, right? That's a George Orwellian concept. But that's all he said, is that the risks that we don't fulfill our mandate is higher than it was 6 months ago. Well, what were the risks 6 months ago? I don't know. And now it's somewhat higher. Maybe it's still a remote possibility, right? Then he said this. He said, while limited, the risk of deflation cannot be entirely excluded. So he's saying the risks of deflation are limited and they cannot be entirely excluded. Does that mean that they think that it's likely? No, it sounds like there's a remote possibility that we might have deflation. We can't entirely exclude the possibility, right? And then he said, we have to act against such risks. And I suppose those words were what set the currency markets rolling because, of course, the dollar had a huge run because, Draghi is promising more QE, sovereign QE. Well, no, he isn't. I mean, how is that statement any different than any of the other statements that Draghi has been making over the years, right? He talks and talks. And how many times is the dollar going to rally and the euro going to sell off on the same promise? Yes, we might do QE. We might do QE. We might do QE. But meanwhile, you have Germany basically saying over my dead body. The Germans don't want full-on sovereign QE. They don't want the ECB loading up on Greek debt or Italian debt or Spanish debt. And as I mentioned earlier, I don't think I think the Swiss have a big dog in this hunt now that they own so many euros and have pegged their currency at 120 to the euro. They stand to lose considerably if there's sovereign QE in the Eurozone because they have all these euros that are going to be losing value and they're going to have to buy more. They're going to have to really back up the truck. I mean, the truck is already backed up, so they're going to have to get a bigger truck to buy all those euros. So I do not think that full-on QE is going to happen in the Eurozone. Again, I think it's just talk, just the way we talk about raising interest rates, even though the economic data is rapidly decelerating. You know, all of the coverage that I'm hearing on the news about the economic numbers coming in weak is all, the glass is half full. People are saying, well, yes, the numbers are lower than we'd expected, but the economy is still growing. Yes, it's growing a little bit more slowly than we thought, but it's still growing. Well, if we're going to go from growth to contraction, we have to slow down first. Yet everybody is assuming that these trends that are now entrenched are not going to continue. If you see this sharp deceleration in growth, how do you know that it's not a prelude to an actual contraction? But everybody is just jumping to the opinion that it's not. In fact, almost all the articles I'm reading, certainly on Bloomberg, are rationalizing and explaining away why we don't have to worry about this bad news, why it really isn't bad, right? And they're making excuses, but they don't do that when the news is good. They never tell you, well, ignore that. That's just an outlier. The news is no. They any kernel of good news, they embellish. They jump all over it. And then if you get some bad news, well, they just completely dismiss it as if, it's just an aberration, something that, statistical anomaly. So that is the bias that has been built in to the media. One significant, I think, development over the last couple of trading days is the gold market. I mean, the price of gold was relatively firm. Gold stocks in particular, the last trading day of the year of 2014 and the first trading day of 2015, gold stocks were up. In fact, gold stocks were probably the best performing stocks during those couple of days. Oil stocks, as a matter of fact, they actually rallied too, despite the weakness in crude oil. But think about the year for gold, because gold in 2014 was basically flat. It might have been down slightly. I mean, not even 1% against the dollar. It was pretty much of a flat year for gold in dollar terms. It just treaded water. But if you remember, all of the forecasts that were being made by the supposed experts at Goldman Sachs and Societe Generale, they were looking for gold to be 1,050, 1,900 and something, right? Everybody was looking for a terrible year for gold. Instead, it hung in there. And in fact, if you compare gold to other assets, it did quite well. I mean, yes, you were better off if you bought U.S. stocks than gold and if you bought U.S. bonds, but you were better off buying gold than stocks and bonds in just about every other country on the planet. The gold market outperformed all the European stock markets. Most of the major stock markets did not beat gold. Hardly any of them did. Also, the currencies. I think that gold is not a currency. I think gold is money. But if it were a currency, I think it was, maybe the second strongest currency of 2014 behind the U.S. dollar. Right? So people in any country, if they put their money in gold, are much better off than if they left their money in a bank account or they invested their money locally in the stock market or the bond market. They were better off in gold. So, I think that all these negative forecasts didn't come true. Yes, gold didn't have a big rally in dollars, but it had a stealth bull market because it rallied in every other currency. In fact, we're very close to significant breakouts in some key currencies like the euro and the Swiss franc. I mean, if gold goes above 1,000 euros to the ounce, that's a significant breakout. Not only would it be a new 52-week high, but it would be a chart breakout. And we're right there. We're at like 991. So we need about a €9 move up to break out. On the Swiss franc, the level is 1,200. And, the Swiss to euro peg is 120, so that would make sense. And we're right below. We're like 1180 something Swiss franc price for gold. And if we break out of those levels, I think that's very, very significant. And I don't think that you're going to have gold in major bull markets in every currency and it not include the U.S. dollar. So if we do get a big breakout in gold in terms of these other currencies, and looking at it, in terms of the Canadian dollar, there, I think maybe around 1,400. I forget the levels. But I think this is going to be very, very bullish for gold. And again, gold is not going to just be in a bull market in euros and Swiss francs and yen and Aussie dollars and have the U.S. dollar the only market in which gold is not rising. See, normally in a strong dollar environment, which we certainly had in 2014, and certainly the latter half of 2014. Normally, when you have a strong dollar, you have a weak gold price. That is not the case now, which again, to me, what it says is it's not really a strong dollar. It's just that all the other currencies are weaker than the dollar, and so the dollar is temporarily less weak than these other fiat currencies. But again, this is all based on expectations, and the expectations are wrong. It's based on the false idea that the U.S. has a genuine recovery that can withstand higher interest rates when it does not, and that Europe and Japan and other countries are in, their economies are a disaster, and as a result, they're going to do quantitative easing, and that quantitative easing is going to weaken their currency. And I think people are overestimating the possibility or probability of QE outside the United States and dramatically underestimating the probability of QE4 in the United States. And of course, if I'm right, if the price of gold does break out in all these currencies, including the dollar, then I think we have significant more upside in gold mining stocks. If you actually look at the gold mining industry, since 2005, the price of gold has tripled since 2005. Yet during that time, most gold stocks are down by 50% or more. I mean, think about that. The price of the product that they're selling has tripled. Not many businesses have been able to triple the price that they sell their products for. Yet despite that, the value of the businesses that produce a product that has tripled in price have collapsed. Now, of course, part of that is because not only did the price of gold triple, but the cost of gold mining tripled as well. Maybe more. Ironically, they claim there's no inflation, but certainly something is resulting in significantly higher cost of mining. But, those costs have come down significantly in the final quarter of 2014 because oil prices have come down a lot. And that is a very big component. Energy is an important component of mining costs. And you have had this big rise in the price of gold relative to the currencies in the countries where gold is mined, which means their labor costs. If you're buying Australian labor or Canadian labor, that is a lot cheaper now relative to the price of gold. So the fundamentals have really improved. But I mentioned Back to the Future at the beginning of the podcast. One of the things that hasn't changed at all since Marty McFly went Back to the Future is the price of gold stocks. I mean, you can take a look at major gold stocks like Newmont Mining in the United States, or Barrick, and these stocks are at the same price they were when Marty McFly got into his DeLorean in the mid-1980s and came to 2015, right? All the other changes that have taken place since 1985, yet the price of these gold stocks has remained the same. So it really shows you how undervalued these companies are at the moment. And I think it really is a historic opportunity when it comes to that sector, because you have this incredible confidence and faith. I mean, that is probably the biggest bubble. I talk about the bubble in stocks or real estate or bonds or the dollar, but the real bubble is in confidence. It's all one big con game, and people just have this incredible confidence in central bankers and in fiat currency and in governments and their abilities to micromanage and stimulate the economies. And that is the bubble that needs to prick, where people completely lose faith and confidence in these institutions and in the fiat money that they generate. You would have thought that 2008 and the financial crisis would have been enough, but no. And that's because they were able to bail themselves out with one final round of massive stimulus. But this is it. When this bubble bursts, there are no more rabbits that they can pull out of the hat. And people, you can look what's going on in Russia right now and see the ruble down sharply. And, the Russian economy is struggling. They've raised interest rates up to 17%. This is just a peek into what's going to happen in the United States. A small little dress rehearsal for the main event, because the real currency crisis is coming to America, right? It's not Russia. I mean, they're going through something, and certainly the Russians who bought gold, gold is at a record high in terms of the ruble. So gold has had a very strong year in rubles. In fact, gold has protected people all around the world from the loss of purchasing power of their currency. And that's what it does, right? But I think the real crisis is going to be in the U.S. And think about this, because if the world is losing confidence in the ruble, and as a result, Russia has to raise their interest rates to 17%, imagine what happens in the United States when the world loses confidence in the dollar. Can we match that? Can we pay people 17% to hold our debt? Not a chance. The amazing thing is that Russia can afford the 17% because they don't have a lot of debt. We have so much debt, we can't even afford a fraction of 17%. We can't afford 7%. We can't even afford 1%. That's how broke we are. And the irony of it is the Russian ruble, if you look at it fundamentally, has got more backing it up than the dollar. So if people can lose confidence in the ruble, considering that they actually are in a better position than the United States, both the fundamental value of their currency and their central bank's ability to defend it. We have no ability. If there really is a run on the dollar, America can't do anything about it. We would need China to do something about it, or Japan, or Europe. We would have to have the rest of the world come in and bail us out. Right? Nobody is aiding the Russians. They're doing it on their own. But if the dollar came under attack, we would have to rely on foreign countries to bail us out. It would be totally impossible for us to defend our own currency. But right now we don't have to, because everybody is buying the dollar, because again, everybody is piling into this trade based on false expectations. But they were making the same trade. They were doing the same thing in 1999. Look how strong the US dollar was in 2000. The dollar index was up to 120. Yes, now it's up above 91 and a half, but it's not nearly as high as it was in 2000. But then it went on an 8-year decline. The dollar index went from 120 down to 70, a new record low. Because all of the optimism regarding the U.S. economy during the dot-com era turned out to be wrong. And I think the disconnect is greater now. I think the optimism is even more wrong. I think the U.S. is on the precipice of a much worse economic contraction than the one we had in the early 2000s. And I think the economy is in far worse shape, structurally, fundamentally, financially. And so if the dollar can have that kind of decline between 2000 and 2008, I can only imagine the magnitude of the decline that's coming. And people need to prepare for it. Let me finish up by speaking a little bit about Bitcoin, and haven't talked about the digital currency since I spoke about the potential for tax loss selling in Bitcoin. And maybe we had some of that when I spoke about it. I think we were about $340 per Bitcoin. This morning, I noticed that Bitcoin's traded below 300. I'm looking at the Bitstamp website. The morning low thus far is 297 per Bitcoin. We're right now trading at 302. So we're down over 4% now on the day. And, even though 2014 was a year where a lot of currencies lost value against the dollar, they all gained value against Bitcoin. Even if you were in Russia and you were worried about the ruble, if you decided to buy Bitcoin with your rubles, you're worse off. The ruble has actually lost, or the Bitcoin has actually lost more purchasing power than the ruble. If you were in America, obviously, and if you were worried about QE and a weakening dollar, that didn't happen. But if you bought Bitcoin, you lost much more of your purchasing power than you would have had you bought any other fiat currency, a traditional fiat currency. The digital currencies did a much poorer job than the fiat currencies of retaining their value. Gold did a pretty good job. In fact, gold did a very good job in 2014. Anybody anywhere in the world who was worried about their currency, and if they use their currency to buy gold, they are better off today for having bought gold, with the exception of the United States, where it's about a push. But if you bought digital currency, if you bought Bitcoin, you are in a much worse position than had you just stayed in your respective fiat currency. And I think that in 2015, despite the fact that there's still a lot of optimism out there in the Bitcoin community for a bounce back, I just think we're going to have another down year. I think that, there's a PR problem now. You have a lot of people that bought Bitcoins in the last year who have significant losses. They've lost half their money, 2/3 of their money. They're a little gun shy, and I think it's going to be hard to attract new people into the Bitcoin community, given, the bad experience now that so many people have had with Bitcoin. I know a lot of people say that price is irrelevant, but I think price is extremely relevant. Certainly when it comes to the potential of a market, a lot of companies in 2014, and that was one of the big successes, and maybe Bitcoin being a victim of their own success, a lot of companies decided to accept Bitcoin. And certainly they were tempted by the high purchasing power because all the people that had Bitcoins had a lot of money to spend. Now they have a lot less because the currency has gone down. Companies like Overstock, which began earlier in 2014 accepting Bitcoin, their sales are far below what they had originally estimated their sales were going to be. Now, part of the reason is because the Bitcoin customer is less affluent, because the Bitcoins that he has are worth less now than they were in the beginning of the year. And so, you can't buy as much stuff. But I think what's going to happen to commerce in the digital currency in 2015 is if the price continues to fall, and let's say the price gets cut in half again, let's say Bitcoin goes down to 150. I think a lot of people are going to be reluctant to spend their Bitcoins because they're going to be hopeful that the price will go up, right? If you paid $700 for your Bitcoin and it's only 150, you might not want to spend it, right? You're just going to sit and hope that it comes back. And if other people don't want to buy because they don't want to buy at 150, what if it goes to 75, right? So I think the commerce could really slow down. And as the commerce slows down, then you're not going to get as many companies that think it's worth the effort to start accepting Bitcoin, because the sales that they're going to have to the Bitcoin community are not going to be nearly as lucrative as they would have been if the prices were a lot higher and more people were continuing to adopt them. And I know that the Bitcoin community continues to talk about how great it is and how efficient it is as a method of payment. And all of that is true, assuming you already own Bitcoin. But if you don't own Bitcoin, and you're simply going to buy Bitcoin to facilitate a payment, well, then I think it's more expensive and more risky than just using PayPal or using a credit card or a debit card, which you can already do on the internet. Yes, there's a fee there, but the fee is not as high as the fee of going in and buying some Bitcoins for the sole purpose of spending them, because now you have the added risk of how much your Bitcoins might go down in value between the time you buy it and the time you spend it. And there are some fees, when you go and buy these fees, the exchanges do charge something. They don't provide the service for absolutely nothing. So I think that a lot of the appeal is going to be lost. Meanwhile, you've got a lot of these companies, startup companies, venture capitalist companies that have been starting up, all based on the supposed appeal of Bitcoin. But the currency itself is losing support. Meantime, again, there are hundreds and hundreds of other digital currencies out there that are stealing some of the Bitcoin thunder. I mean, it's not like you just have one digital currency. If you want to buy a digital currency, there's all sorts of currencies that you could, take a shot at. And so they're all out there. There's a lot of competition. The supply is growing. More and more are being mined. And I think the appeal is going to be lost. And a lot of people think, again, they say price is irrelevant. I think it was the price. It was the meteoric rise in the price of Bitcoin that made it so exciting. And it was the expectation of future gains that was enticing people into Bitcoin. People thought they were going to get rich. I know initially the appeal of the cryptocurrency was some libertarians and free market guys. They wanted a currency that wasn't, manipulated by a central bank. They wanted privacy and things like that. But all that has been lost. I think it was all overshadowed by the greed associated with the promise of, riches for anybody who got into the Bitcoin. And which is why the whole thing took on the aura of a pyramid or a Ponzi scheme, where everybody was hyping it up, and the people that owned it need to convince new people to buy it, because that would increase the value of their own coins, and they would look to cash out. And so, but I don't think that the bubble is totally burst yet, because I think, we still have a lot of hope. And then once the price really starts to tumble, then I think you're going to see Gresham's law kick in. I mean, initially, people are going to be reluctant to sell. They're going to want to hold on to their Bitcoins, so commerce will dry up because people will be hoping that the currency comes back. But when it falls far enough, then people will give up hope, and it will be more about get me out at any price. And, the Gresham's law, good money chases out bad money. If Bitcoin becomes the example of bad money, where anybody that has bad money wants to spend it, right? So now people will be rushing to spend their Bitcoins before they lose value. They'll be holding on to their other currencies, right? But they'll be putting more and more Bitcoins into circulation. But then that'll just simply drive the price down even faster as everybody wants to spend it. And that's what, you get the pickup in the velocity too, right? Because if you get a Bitcoin, you better get rid of it before it loses even more of its value. And so I think, unfortunately, that is an event that we might see in 2015 or 2016. I don't know how long the whole thing is going to take to play out. But anyway, hey, that is it. Again, I want to wish everybody a very happy new year. I think it is going to be a very volatile 2015. I think it's going to be full of a lot of surprises for a lot of people. I do not think this year is going to go anywhere near the way the vast majority of people believe.
Today's financial advisors behave like pro wrestling TV commentators. They scream that the recovery is strong, debt is manageable, inflation is low, and that the Federal Reserve has everything under control. They may be oblivious, but the danger is real. Looking beyond the media hype can open a world of broader investing ideas. Euro Pacific Capital is a registered investment advisor that offers stock-focused wealth management services that closely follow the strategy of our founder and CEO, Peter Schiff. We concentrate on those countries that are more closely in tune with Peter's vision of how capitalism is supposed to work. And these investments are not hard to find, provided you know where to look. Isn't it time you change the channel and let Euro Pacific put a little reality back into your portfolio? If you live in the United States and have $25,000 or more to invest, call 800-727-7922. That's 800-727-7922. Non-U.S. residents access similar strategies through Euro Pacific Bank at europacbank.com. Euro Pacific Capital and Euro Pacific Bank are affiliated companies.